Um, Rostin Behnam, or Russ Behnam, who's acting chair of the CFTC, is also head of the market. He directs the Market Risk Advisory Committee at the CFTC, and at least 3 people on this call are members of that committee in varying capacities. And in that committee, he prepared or directed to have prepared the report that Bob Litterman chaired on climate risk for the financial system. In addition, as acting chair, Russ has set up the climate risk unit at the CFTC. And I've asked him to talk a little bit about both those things in the context of the things that they're hearing today. So Russ, over to you.
Thanks, Dick. Can everyone hear me okay?
Yep.
Oh, good, great. Good afternoon, everybody. Dick, thanks for that kind introduction. Thanks to Robert Engel and Dick, as you as well as the Volatility and Risk Institute for hosting this conference. Couldn't be more timely, and it's really just a pleasure to kick off this particular panel, the Risk Transfer and Insurance panel. It's been a great discussion all day, and like I said, with what we've seen, I think from a U.S. perspective in terms of shifting mindsets about climate change and climate risk and the role financial markets are going to play, today's event could not be more timely. So certainly a pleasure and an honor to be among today's panelists. Many, as Dick mentioned, I have worked with during these past several years, and I think each of whom has really helped build the momentum needed for our industry, the public, policymakers, to recognize the impact of climate change, and that we can't compartmentalize it any longer. It's not just an environmental issue. It's not just an energy issue. Financial markets, the economy, there's a lot of different elements to climate change that we need to be thinking about. And not only are there risks obviously associated with financial market stability and resilience, but there are opportunities that financial markets can play. And as we just heard, with respect to carbon markets, carbon trading, and this sort of development and evolution of more nationalized markets. We're at an inflection point in the climate discussion, and I'm confident, as I said, that today's conference is really just going to further that discussion and move us forward collectively. There's now, I think, more so than ever, a common understanding that climate change not only presents systemic risk and subsystemic shocks, a term that was sort of coined in the MRAC report Dick mentioned, and wide-ranging ripple effects to the U.S. financial system and the larger economy. It presents opportunities, as I said, as we sort of work to ensure decisive and cohesive leadership over our markets and our institutions. And we charge them with monitoring and managing risk and capital and asset allocation, especially as physical risks of the sudden and extreme weather events associated with climate change have an increasingly profound impact on our most vulnerable communities. To that end, I want to highlight and commend Commissioner Lee, who I know spoke earlier, on her leadership in spearheading efforts to incorporate climate disclosure and climate risk by seeking public comment through the creation of the SEC's Climate and ESG Task Force. I'm confident that both she and Chairman Gensler will accomplish a lot together over at the SEC. But before I continue with some remarks, I do have to mention that today's comments that I share with you are my own and do not represent the views of the CFTC or my fellow commissioners at the Commission. I'm here today, as Dick mentioned, in my capacity as acting chairman of the CFTC, because I'm committed to bringing climate change more clearly into the regulatory fold to ensure that the structures, tools, strategies, products, people, and ultimately the policies are in place to address the physical and transition risks we as a global community are facing. If we start building better equipped financial systems now that both acknowledge and account for the inevitable impacts of climate change, we can be positioned to avoid the need for extreme shifts in balance sheet management and fiscal and monetary policy in the future. In November 2019, following a full Commission approval, as Dick mentioned, I formed a 34-member climate-related financial market risk subcommittee within the MRAC, which Bob Litterman, who we'll hear from later on this afternoon, served as chairman. I gave the climate subcommittee a very broad mandate, specifically providing analysis and recommendations regarding the existing and emerging risks and impacts of climate change on financial markets. The climate report, in many respects, exceeded all expectations in tackling the challenges of how to safeguard the financial system in the face of uniquely complex risks presented by climate change and how to facilitate the transition to a low carbon, climate resilient economy. Recognizing our unique circumstances in the US, which included a multifaceted system of financial regulation, myriad regulators, which we all know, the climate report with its 53 recommendations provides a resource, I believe, to interested policymakers, regulators, academics, and stakeholders as our nation begins taking thoughtful and intentional steps towards building a climate resilient financial system that will prepare us inevitably for the decades to come. As detailed in the report, we can start where many of our international regulatory and supervisory counterparts and domestic private sector entities have already begun. We have to rethink our political and corporate culture so that our economic pillars are less vulnerable to climate shocks. Recent discussions have highlighted that when the US presents a more detailed approach in terms of standards, taxonomies, disclosures, accounting, and capital in managing both the risks and opportunities of climate change, we need to ensure that adoption and compliance can be achieved across jurisdictions. We can't harmonize for the sake of harmonization. We need to partner with one another and with industry to ensure that there is appropriate flexibility and a focus on returns for all the efforts that we're going to put into this challenge over the many, many years ahead. To that end, in March, I announced the establishment of the Climate Risk Unit, or the CRU, within the CFTC. The CRU is comprised entirely of staff across our offices and divisions and will focus on the role of the derivatives markets and the CFTC as a market regulator in understanding, pricing, and addressing climate-related risk. To that extent, the new products and market developments must accurately, uniformly, transparently, and fairly factor climate-related risks into pricing and related market functions. The Commission needs to engage early in order to ensure coordination within the larger financial regulatory space, both domestically here in the US and abroad, and to provide support, I believe, for the private sector, the industry, and the market to develop these products. The CFTC's unique focus on risk mitigation and price discovery puts us on the front lines, as we will increasingly need to use our wide-ranging and flexible authorities to prepare for and address the impact of climate change, and more specifically, the transition to a low-carbon economy. In thinking about the future of the CRU as a resource for the Commission and the current administration's all-of-government approach, the goal is really to dedicate the resources we have towards raising risk management awareness and visibility within our markets and the broader economy so that we can identify where the holes are, where we need to be most vigilant in both our support and leadership as regulators and policymakers. As I mentioned earlier, the CFTC is uniquely poised to oversee the role of the derivatives markets for hedging, price discovery, market transparency, and facilitating the allocation of capital towards sustainable investments. In particular, hedging of interest rate, FX, credit risks, resulting from the issuance of trillions of dollars in capital that will be required to finance transition to a low carbon economy will undoubtedly incentivize development of new products. This will likely occur in tandem with refinements and modifications to existing derivative instruments to reduce derivatives market participants' risk exposure. For example, commodity derivatives exchanges could address climate and sustainability issues by incorporating sustainability elements into existing contracts and developing new derivatives contracts to hedge climate-related risks. New products may include weather, ESG, and renewable generation and electricity derivatives. The CRU will also begin thinking about market structure issues that may arise out of the development of a robust and liquid voluntary carbon market. Derivatives exchanges have a long history of developing and enforcing standards for derivatives contracts. They generally have unique knowledge of the underlying marketplace and have long-standing relationships with market participants. Our role at the CFTC as a regulator is to support the industry-led process and apply and enforce existing standards under our governing statute, the Commodity Exchange Act, and its regulations. Leveraging our in-house expertise and history of working alongside exchanges and self-regulatory organizations, I believe the CFTC CRU will ensure the agency remains a helpful participant in all relevant discussions. As new types of risks emerge and the markets develop the means to address them, regulators and lawmakers must ensure that the existing framework is adaptable, or makes necessary changes to support firms attempting to incorporate sustainability into their business models. We may need to reconsider aspects of our regulatory oversight in terms of disclosure, risk management, capital and margin, and reporting. And I'm open to rethinking these parts of our oversight if it means long-term risk reduction through increased incentives and action by market participants today. At the heart of the MRAC, the climate report, the CRU, and my remarks today is the concept of partnerships. In speaking about climate change and financial market risk and what role policymakers should and could play, it's all about partnerships. As the remit of our new administration supports a firm commitment to full participation in the global effort, I am fully prepared for the CFTC to be an active player, partner, and leader. And to that end, I want to end these remarks by thanking again our hosts and the fellow participants for putting on this excellent event, discussion. This is exactly the type of discussion we need to have collectively in order to move the conversation forward. Certainly look forward to working with you all in the near future. Dick, thanks again for the introduction and the comments.
Thanks very much, Russ. That was terrific.